Good morning, everyone, and thank you for joining. We were just giving it a few minutes to get everybody in, and it looks like we've got a good crowd this morning. We appreciate you joining the Milner Group today to discuss legacy planning strategies through the use of annuities. Generally, when we think of legacy planning, our go-to product is life insurance. But what about the clients that no longer qualify for life insurance, or maybe they simply just can't afford the premiums because they've waited too long? And what about clients that already have an annuity, but their beneficiaries are worried about the tax implications of taking the proceeds in a lump sum? And then finally, clients that like the immediate annuity concept for income, but are concerned that they may not recoup the original investment before death. This is where annuities come in. Not only will annuities provide tax deferral, which we all know, and on the fixed chassis, they're guarantees, but they do also provide opportunities for enhanced death benefit and wealth transfer mechanisms to satisfy these very concerns. I'm Julie Stewart, Annuity Director here at the Milner Group, and I'm joined today by our annuity product specialist, Warren Yancey. Warren's going to run through 3 legacy planning ideas that we feel you can immediately apply to your practice and provide as solutions to your clients. Now, this is a live recording, and we will send out the replay as well as post it to our YouTube channel. So if you're not familiar with the Milner Group YouTube channel, I encourage you to go look it up. We have all sorts of videos and webinars on life, long-term care, and annuity products and strategies that we've presented throughout 2016. And during this webinar, if you have any questions, there is a chat box on the right, and we encourage you to just go ahead and type your questions in, and we'll answer them in real time. So without further delay, Warren, take it away.
All right, good morning, everybody. As Julie mentioned, my name's Warren, and I'll be taking you through the webinar today. We know that your time is valuable, so I'm going to go ahead and get started. I want to begin with just a quick overview of some of our goals for today. One of the main criticisms that we hear against annuities is that when you die, your beneficiaries are left with nothing, but the reality is that annuities can often be a very important legacy planning tool. So we want to run through a few scenarios where fixed annuities can help ensure that funds don't run out after death, provide an alternative to traditional life insurance, give tax breaks, and help clients donate to causes that they care about most. So our hope is really to leave you with at least one new concept to present to some of your prospects. Our first topic is the non-qualified stretch or life expectancy method. And this is a concept that can also be used with an IRA or qualified funds, but we're going to contain our discussion today to non-qualified money since that's the lesser known concept of the two. And this is really perfect for a client that is planning to pass funds to beneficiaries, but that may be concerned about tax ramifications or about money running out early. The way it works is that a beneficiary's life expectancy is going to be used to determine minimum payouts to be taken each year after the original owner passes away. And as a result, this is going to spread out the inherited assets, and it's going to lessen the tax bills while continuing the tax deferral. And this can be made either voluntary or involuntary by the original owner. And you might ask, why would you want to make it involuntary? But if you're concerned perhaps about reckless spending from a beneficiary or want to make sure that they don't use it all at once and that it really lasts over a lifetime, it might be a good option to consider. Now, if you do go with a voluntary method, the beneficiary can elect to take more money if needed beyond just that minimum requirement. And one of the great things about this strategy is if the beneficiary dies, they can name their own beneficiary who can continue receiving payments. So it really can be a gift that spans multiple generations and really leaves a legacy as opposed to just being a one-time payment. Now we're going to take a look at a concept that you can use to provide a life insurance alternative. And this is going to use a fixed indexed annuity with a death benefit rider. For this particular slide, we're actually going to go through the features of a specific product as an example. This is the Spectrum Mark offered by Legacy and F&G. And I think the real selling point of this product is that while the death benefits aren't going to be tax-free like life insurance, there's absolutely no underwriting required. The client only has to fall into the required age range, which in this case is going to be a maximum of 85 years old. But there's going to be no medical exams and not even a phone interview. So all they have to do is be under age 85 and they will qualify. And the way that this particular product grows the death benefit is it's going to apply a 3% bonus, and then it's going to grow at 5% simple interest for 10 years. And then that fund can be accessed as a lump sum. But where things really get exciting, and the option that we recommend considering, is spreading the payout over multiple years. Because then the interest rate goes to a compound 6.25% and still receives that original 3% bonus. So that's quite a bit more accumulation, and it can really pay off. And again, as with the stretch provision, the contract owner can mandate that a multi-year method be chosen in case they're concerned about beneficiaries maybe spending the money too fast. I think it's also important to remember that this is a traditional fixed indexed annuity, so it's accumulating interest regularly, and although it's best used for wealth transfer, if a client does end up needing some extra money, maybe they have home repairs they need to make or they want to help out kids with a payment, they can take those free 10% withdrawals after year one. And this particular product actually has an income rider as well that can be turned on in the event that they need more to cover their regular expenses. Now, here's a detailed illustration of this particular product that shows the potential of the death benefit base. And for the purposes of this example, we're going to use a 65-year-old male in the state of Georgia with $100,000 to pour into the product. And we can see that after 10 years, for a simple lump sum death benefit, it's going to grow to $154,500. But it's an even higher $183,000 if taken over 5 years. And remember, this is spread over 5 years if it's purchased before age 70. If it's purchased after age 70, it's actually going to be spread out over 10 years instead. So just something to note on there. And another great feature of this product is that it does allow flexible premiums. So if the client ends up deciding at a later point they have even more money that they want to add to increase the death benefit some more, they're absolutely able to do that. So in short, very versatile product, great for wealth transfer, and it actually has one of the largest average case sizes of any of the products that we offer here. And now we will pivot to another type of product, and this is for a client that maybe isn't as wealthy and does plan on needing income now, but is worried about that income ending early if they were to pass away. And we know SPIAs are great for immediate income, but again, some clients want a little bit more peace of mind than a life-only payout, which is going to maximize the income. And many of you are probably familiar with certain period options and those guarantee payouts that last a fixed number of years. But a lesser-known guarantee feature that we suggest considering is a refund option. And many of the top agents use this to essentially provide an ROP feature for their clients. And so the way that this would work is if the owner puts in $100,000 and dies after receiving, say, $30,000, their beneficiaries will collect $70,000. So again, no underwriting involved, and this feature is actually available up to age 95 with a lot of our carriers. And just like the death benefit in the previous product, this allows for either a lump sum or continued payments in exchange for higher payouts. The owner is going to choose that at the time of purchase. So let's take a look at another illustration. This is a great breakdown of a SPIA with multiple payout options from American General. We're going to use the same 65-year-old male client in Georgia, and we see that a straight life-only SPIA would pay just under $6,000 annually, but those payments are going to stop immediately upon death. So as an alternative, the client can guarantee the full $100,000 is paid out while still getting payments of either about $5,350 if an installment refund is used, which again continues those fixed payments for the beneficiary until the initial premium is returned, or $5,250 if they want to give that benefit as a lump sum to their beneficiaries. So on the next SPIA case that you quote, try to show your clients a refund option and see if they like the added safety. We're going to close with our last concept as charitable gift annuities. And this is a somewhat advanced planning concept, but charitable gifting with an annuity is a great way for clients to transfer assets to charities that they're passionate about, but they'll still reap rewards of tax breaks and lifetime income. Basically, the way it works, as you can see in this illustration, is a donor elects to give assets, usually something like real estate, securities, or just liquid funds, to a charity that they're involved with or a university they attended, etc. And that organization is going to use a portion of the funds to buy an annuity that's based on the donor's life expectancy, and then they're going to keep the rest of the assets. So the charity receives fixed payments from an actual insurance company that they purchased the annuity from, and then they're going to pay those income payments back to the donor for the rest of the donor's lifetime, often with reduced tax consequences. And the advantage for the donor is that they get an immediate tax write-off the year that the gift is made, and the advantage for the charity is they're left with any remaining assets upon death. So it's a nice win-win scenario for both parties involved. Now, this is usually set up through the charitable organization itself, and payouts can vary greatly, so we don't have an exact illustration here, but I wanted to go ahead and take a quick look at a hypothetical scenario. Again, we're going to use the same familiar 65-year-old male in Georgia with a $100,000 premium. And giving a gift of $100,000 could save them anywhere from $12,000 to $15,000 in the year that the gift is made, assuming that they're in a high tax bracket. And remember, this is going to be reserved for high net worth individuals, so they likely will be. And the organization usually agrees to pay out somewhere between 4.5% to 6% of the original gift's value each year. So they, in this case, they would purchase an annuity that would pay out $4,500 per year, and then they would use the remaining funds to invest in their causes. And each university and charity that is well known and large typically has their own charitable gift annuity programs. So be sure to reach out to them if your client is interested in setting one up. And oftentimes, the donor can actually be involved and have some input on how the funds that they donate are used by the charity. So this is a really great way for a client to give to charity, and instead of having to wait until they die, they can start to see the benefits of that gift and how it helps the charity, as well as realize tax breaks and get income. So can be much more advantageous than just leaving something in their will to go to a charity, something that they can enjoy while they're still alive. And that's going to wrap things up for today. I know that was pretty quick, but we will be sticking around for a few minutes to field any questions, as Julie mentioned. And while we're waiting for those to come in, I just thought I'd give a few final thoughts. We do always encourage that you bring in a client's family members when discussing these types of plans, especially toward the end of the sale. We think it's important that spouses and children know how their loved one's wealth is being handled and what they can expect in the future. But it's also a great opportunity to build trust and potentially gain new clients. So with that, I'll see if you have any questions.
Yeah, and I'd like to add too, with the non-qualified stretch, I mean, that's just a very powerful solution for generational planning. And asking yourself, you know, are you working with, or do you have a relationship with your client's children? As Warren mentioned, if you don't, bring them in at the end to help them understand why things are being structured the way they are and really how that benefits them as well, especially with the stretch concept. It's a way not only to stretch wealth over the beneficiary's lifetime, but really it enables them to think about, okay, well, if I'm not in need of all the money immediately, not only can it be stretched for my lifetime, but also potentially for their children's lifetime. So generational planning, and it's a very easy concept and sale. And I think Warren had touched on this as well, that once the stretch is implemented, they are required to take a minimum distribution, but they do have access to the money. So it's not like they're cut off and said, hey, it's just the RMD so that it stretches for your lifetime. They actually can pull out additional funds if they need it. But again, giving them the stretch opportunity, giving them wealth over their lifetimes, and potentially planning, for their children as well. We do have some great A-rated carriers that allow this type of opportunity. So it's definitely worthwhile to look at. And there's also opportunities there for qualified money, as Warren also mentioned. So we do thank you. Warren, are there any questions?
Yes, I am seeing a couple questions come in. Larry is asking what the minimum investment for the SpectraMark product is. And Julie, I believe that's $10,000. Can you verify that?
I can verify that. Give me 1 second. What is your next question, Mom? Just pulling that up.
Let's see. Dave asked, what was the name of the AIG product and the charity transfer product? The AIG product was just their SPIA, which is American Pathway Single Premium Immediate Annuity. And the charity transfer product is not an actual product. It's usually worked out with the charitable organization itself. So there's not really one product earmarked for this. There are carriers that are friendly with charity transfers, and American General is actually a great example of one.
Yes, that's correct. Okay, so the minimum on the SpectraMark is $10,000, and then it's a $2,000 minimum for additional premium. So if the clients wanted to, make flexible premium payments, and as Warren said, with the charitable gift annuities, generally the charity is going out to ascertain or to obtain that immediate annuity contract, but they're typically looking at the best rates in the industry. So just as we do here at the Milner Group, we have access to over 50 carriers. We will go out and query to see who really is paying the best rate today, always generally sticking with A-rated carriers. So there are a multitude of options, and it is pretty much rate driven.
Okay, well, that is all the questions that I'm seeing for now. You can always feel free to contact us. Our main line is 1-800-926-9206.
Perfect. We do appreciate everybody's time today. We look forward to working with you, and we hope you have a successful day.